First off, let me give a big intro on you, a bit of background. So Tess is the CEO and founder of Stride Funding, a venture-backed fintech company that offers more flexible alternatives to traditional student loans via deferred tuition agreements and income share agreements, DTAs, ICAs. She founded Stride from a student-first perspective as an MBA at Harvard Business School. She's a serial entrepreneur that successfully exited her previous company while completing her Bachelor in Science and BA degrees at the University of Pennsylvania. Tess worked in investment banking at Goldman Sachs and in private equity at Vista Equity Partners. Tess is also recognized as a member of the Forbes 30 Under 30. So in short, you're a rock star. That's amazing. Welcome, Tess. So happy to have you join us here and share your journey. And we appreciate you giving back your time to a founder community with your time. So really appreciate you having here. Thank you.
Absolutely.
All right. So before talking about your journey with Stride Funding, I want to highlight a lesson or some lessons learned from your first venture, Sociana. Can you give some background on why you created that company? What problem were you solving? I think you were 19 at the time.
Yeah. So yes, I was. I actually feel like your first go at things, you learn a lot of what to do, but more importantly, what not to do when building a business. And I think that for me, there were a number of lessons. One, I definitely saw firsthand just the power of, asking a lot of questions, surrounding yourself with early supporters. But ultimately, one of the biggest learnings for me was, you really need to understand the market. We spent so long on product in a vacuum and making assumptions of what we thought the end customer wanted, right? And, I think the lessons there were like, get out early, soft test everything, like be on the field. And this go around when I founded Stride, the first thing I did was go on every single campus. Luckily, I was in Boston, right? There are a million campuses nearby, and ask students just lots of questions, and then talk with investors and understand where do they want to put their capital, and then talk with schools and understand what are their pain points, and ultimately create a product that there's inherent demand for, versus spending a lot of time building and then having to rebuild and reconstruct. And I think from an efficiency perspective, that was something that I benefited from. But ultimately, that business and Stride, both, the underlying similarity is they're both very much mission-driven first, right? And but different populations, different products. And so
and what was I was going to say, what was Sociana's product?
Yeah, so that was a software platform that essentially helped companies manage their CSR, their corporate social responsibility initiatives. So do analytics around their corporate giving and their volunteerism efforts, and then how do you package that into ways to market when you attract and retain talent? And ultimately, a lot of large companies, as you've probably seen, have doubled down on that double bottom line, do well while doing good. And ultimately, employees have looked for companies that share in those values on how companies are allocating their resources and also attracting employees and allowing them to invest in their own ways of giving back. And
that's amazing. How long was that journey with Sociana?
So that journey was about about 3.5, 4 years building the business. And ultimately we had a larger player kind of engulf the business. I would say that, again, for me, it was really great to see that we had early investors who were willing to take a bet on us. And secondly, was able to just form views on how do we think about a team, building a team, thinking about engineering. Should it be all in-house? Should we do offshore? But I want to be really clear. Like I learned a lot, but I also made a lot of mistakes the first go around. And I think that's a lot of what accelerated, how Stride came to be and how we've grown.
Aside from that really big lesson, which is actually speak directly to who you believe is going to be your customer, and have those conversations first instead of building out your product and
Yes.
continuing to work on that hypothesis without actually speaking to a customer. Are there other things you mentioned about development team? So a
Yes.
lot of team building. Are there things
Yes.
that you say, you know what, like, do you feel you went you recruited too quickly, or there's a couple
Yeah.
of
No,
common.
there's a number of things that I've learned from that experience. And so another was around, especially both Stride and Switchana were ultimately, technology first businesses where the platform experience matters, and your end customer, whether your channel is B2B to C, is the C, right? The consumer. And I think the first go around, we were trying to be so scrappy that we looked at, building through almost entirely offshore teams without having a full-time expert in-house, right? And ultimately, there's a lot of judgment calls when it comes to the architecture, the ways you're constructing it, and things that get lost in the game of telephone.
Mm-hmm.
You're explaining what a finished product looks like and what the why is and why they want to use this tool and what the consumer needs to be able to do, and how it's going to scale over time, right? What that roadmap looks like.
Mm-hmm.
And this go around, I actually took a very different approach, which is building an entirely in-person, in the same office engineering team in Boston, led by, obviously biased, but our head of engineering, Andrew, was just fantastic. And now we've hit the point where we're growing very, very quickly, and he had kind of diligenced 11 different firms to supplement or complement the team that we have. Can we work with kind of a South American company? We met with 11 firms, did a ton of vetting on how they incentivize their employees, what the integration is, are they co-working together or co-locating? How do we integrate them with our team? And actually, it's worked really wonderfully because we have the full-time lieutenants in our team navigating the builds and the road mapping, and then kind of having that additional manpower. And I think it's actually shown me that it's not a one size fits all. Just because my first go around, I had experience that was less than ideal on the initial build. It's actually more structural on the point in time in which I had kind of offshore versus full-time in-person folks, and also who was leading that side of the house. And so
that's awesome. That brings up a good point about the hybrid and not hybrid, workspace.
Yes.
So most of your team, the core, they're all
yes.
in one office.
Yes.
And then all the
Yes.
other partners, or they work remotely from wherever you mentioned.
Yes.
Okay, cool. And do you foresee at all mixing that up, or so far
Great question.
it's
Yeah. So there are real pros and cons, and this is a internal discussion as recently as this morning that we have on how do we think about ability to scale over time in an evolving market where more and more companies are seeing these hybrid models. I think our philosophy has been, right now we have a hybrid model where folks come in 3 days a week in office. We do have, so I'm going to talk about the recruitment side and then the retention side and how we see impacts on both. So from a recruiting perspective, it does impact your top of funnel to have our entire technical team based in Boston, our full-time team. Because obviously there are candidates who are only looking for remote work. With that being said, we've also attracted some excellent talent that chose us partially because they had worked at remote first companies and missed the whiteboarding sessions, team bonding events, just
the energy,
the kismet that happens when you just turn around and say, are you blocked on this? I actually just saw, there's something that happens organically that is special. But you do, again, lose a lot of top of funnel talent that is really high quality. Also, we're in a region that's not a low cost region. And ultimately, when you think about, finding folks that fit very different skill sets, we have a lot of top quality data scientists, engineers, working on different products within Stride, again, it's not always guaranteed the region you're in is where the absolute best talent for exactly the roles you need are. I will say we have the fortune that Boston is a pretty good hub.
Mhm.
A lot of really smart technical folks in the region.
Yep.
But the question is, how does that scale when, we have a company that's, many hundreds of people or thousands of people, right? Now, with that being said, on the retention side, there are some real benefits for the in-person. I mean, it's, been 5 years and we've never had an engineer voluntarily leave. I
Wow.
mean, that's nuts.
Yeah, that is nuts.
Any company, and that's just not the case. Doesn't mean we don't hold a high standard on our side, but again, like that's really unique. And I think retention wise, we do have some folks on the non-technical side that are remote, and over the last 3 years, the only churn we've had at the company has been our remote teams.
Huh, that's interesting.
So I do think that it is easier to recruit in a remote basis.
It's also easier to lose.
Easier to lose. With that being said, I think that there are a lot of tools that have been built over the last few years to be more conducive around remote work. And so as long as folks can be really disciplined on like the project management tools, the ways to virtually whiteboard, creating those natural moments. And then if people happen to be based in hubs, even if there's not a physical office, like creating that connectivity where you still see someone every once in a while, like there can still be a beautiful way to work together that doesn't require a set number of days in office, but it just requires a lot of planning and a lot of thought to do it right.
Yeah.
And once you switch to remote, and I'm not talking about hybrid, which is a few days in office, but truly remote, you can't put it back in the box. And so we are thoughtfully thinking about, as we keep growing as fast as we have, how do we think about managing a team, and should it be fully, here, in office?
Initially, the core team all were under one roof.
Yes,
Okay.
exactly.
That's really interesting. Yeah. With our company, it's remote, but I have to say that we just got back from once a quarter. We meet up in Colombia, in South America, where I grew up, and like those sessions are 10 times more productive than I come back and I'm like, okay, not only was it's great because the energy, it just feels, it feels way different. And on top of that, you look at what you came out with just in a week, and you're in terms of productivity, and you're like, wow, that's pretty crazy. So there is something there, for sure. Now so I want to jump into Stride funding. So after your first venture, you continue your education. You got your MBA at Harvard, which really hard to do. Then working at Goldman, then Vista Equity. And then what led you to create Stride Funding? How did it get started? What problem were you solving?
Yeah, so, I think with Stride, one, I was a bit more intentional, knowing I had this itch to build again. And, I actually spent quite a while asking folks, everyone, friends, family members, Uber drivers, people at bars, like, if you could solve one problem, what would be, or what's the one thing that's, bothering me, right? And everyone, and I had just been admitted, or not admitted, but I just accepted going to HBS. And so I had also all of these friends who were about to pursue graduate school with me. And whether it was my friends who were about to go to grad school or Uber drivers, folks were like, I want to go back to school, but it is so expensive. Is it worth it? Over and over and over again. And to see the same point of view from folks across the full spectrum tells you there's something there, but what is it, right? And ultimately, I think it was realizing, I've worked in environments where ultimately we live in a world that is so much more is possible with the amount of data we have and the types of middleware or tools that exist, that it felt backwards that when you actually look at student lending in particular, the system is quite broken. I mean, 92% of private loans require a cosigner, which really just means a wealthy parent, family member. Right?
Mm-hmm.
And the whole point of going back to school is to do better than your family, not to rely on them for access to funds. And if you don't have a cosigner, you get very, very expensive products. And education is one of those few points in time, it's an inflection point in someone's life where what they're earning today as a barista on campus is very different than what they're going to earn when they graduate as a nurse, right? And so we just realized that, of course, making sure students don't have bad credit or track records to not making payments is important. But FICO alone is not a great metric of ability to repay because a lot of people just have thin file credit, right? They didn't have the financial literacy to learn, hey, you need 7 years of history, start early. And that was something I thought, you know, we could
That
really,
especially hurts minorities.
it especially, and I'm first generation, you know, my family, my parents immigrated here. I really do personally, feel for the fact that, yeah, it's pretty crazy how a lot of populations who are especially not taught at an early age about financial literacy are those that, you know, I feel most connected around how can we help, right? And so that was where Stride initially came from. And my background was in finance, and I thought this space around you take mission, connect it with finance, you connect it with education. I'm in Boston on a campus, was kind of this perfect, you know, storm of being able to build something that, you know, could really make a dent.
That makes complete sense, and it's very cool to see leveraging your strengths and your background. Yeah. Before moving further, what are deferred tuition agreements and income share agreements for those that have not heard of that?
Yeah, absolutely. So we have 3 products now. So our most vanilla product is a non-cosigner loan, right? So principal interest product, but we underwrite students where, again, we look at their future ability to pay. So the programs that they're in, what they're pursuing, to be able to underwrite them without a cosigner. We do that same type of underwriting across each of our products, but the way the product is structured is where the difference is, right? So with the most, I would say, innovative of the 3 is an income share agreement. Instead of an interest principal product, students repay as a percentage of their income. So it's almost like it's the most incentive aligned product. When you earn less, you pay less. You earn more, you pay more, and there's caps, right? So never pay more than a certain amount. But it really helps schools drive enrollment and students to have that confidence to know, hey, I'm making a good bet on this education because, well, someone else has skin in the game with me, right? My school or my investor, because my outcomes are going to determine my payments. And when there's an issue is when someone pays a lot for their education and then finds out, whoa, the job market is hard and I'm not able to now, you know, manage this. And then the deferred tuition agreement's kind of an in-between, still have an income trigger, only make payments when you earn above a certain amount, but it's fixed dollar amounts. So it's kind of a blended product.
I love what you said about the alignment. It just aligns. I mean, for universities, it's also, I'm guessing, a big bet on their case, which that whatever they're teaching can prepare that student for, you know, for a career that they'll be able to pay off that tuition, which for a lot of times, you know, you've seen this in, I've come across many universities that got in trouble with that, with courses that were not really, you know, the online universities and all that stuff. There's a lot of stuff out there about that.
Yes. And I also want to add to that and say, you know, it works on 2 sides. One, it should help schools because they're able to stand behind the value that they're driving, but it also holds schools accountable because, you know, if a student sees Stride is working with a school, they should know we've done a lot of vetting on the front end around outcomes of those institutions, right? So are these schools with good completion rates, good placement rates, good starting salaries? Are these institutions that truly deliver on their promise of educating the next generation and doing so in a way that is good for the student? And that cuts across all sorts of programs that we work with across degree and non-degree. So
when I know that we have many members that have kids and their kids are already in high school as well. So just very quick for them as they're listening to this part of the portion here, if they had not heard this before, what is, so we get a sense for what is great about it. What are some things that they should consider when they're thinking about going with Stride or like with an income sharing agreement versus what is already out there?
Yeah. So I would say, you know, it's funny because it's more so about making sure it's an institution that we support, right? Once we work with someone, I wouldn't say there's really I like genuinely mean this, that we have been very intentional since the early days of Stride of making sure that students did not have to choose between flexibility of their product and affordability. I'll give you an example. One of my biggest lessons in life is like, just as important as probably even more important than the yeses you say in life are the nos. And the first term sheet we had for capital to fund the students was actually from like a large hedge fund. It was very expensive capital. Would have been fine for our business model, would have been fine for, you know, all sorts of things, but it would have made the product really expensive, right? Which means, yes, they get downside protection. If they're earning less, they pay less. But ultimately, the expected returns would have been very high. We ended up saying no to that, going back into market and bringing on large impact investor capital, really low cost, like, you know, single digit capital, that allowed us to actually structure it in a way that, you know, we could actually genuinely tell students, we're here for, like, we are doing this to do something better. Now we are going to vet the schools and programs that you go to. So we want to make sure that, you know, like where you get access, you know, who you can attend. Now, if you're, so with
and
that
does this work for everybody, or there are occasions that it's like, well, you actually are okay doing it this way?
Yeah, so we focus on programs that are low variability. So it's not about searching for the program that makes the highest earnings, but one where we can bake in the least risk so we can drive really affordable, you know, pricing to students. So as I mentioned, nursing is one of our biggest segments, engineering, data science, accounting, you name it. We do it across degree and non-degree. So we work across, you know, boot camp programs, university programs, and trade school programs. But there are, I mean, you can think of them yourself. There's a lot of programs, like a teacher would be a very low variability, stable program. But there are a lot of programs that take an MBA, what I was, aren't always perfect. I mean, it doesn't mean we have funded MBAs in the past, but a lot of MBA programs that are highly variable outcomes, right? And so doesn't mean we can't do that. It just means that our loan product might be a better fit than our income share agreement product, right? And that's fine, right? That's the whole point, is we have multiple products because they're meant to be menu options. And we tell every student, you should always think about your individual circumstance. Like, first take grants and scholarships. Free money is better than any other type of money. If you're in a degree program, then look for subsidized federal funding, and then look at Stride as a great alternative to other types of private loans. In the non-degree space, there's not federal funding. So that's where, you know, our value prop is even stronger, because there's just not as many options that exist.
So when you created Stride, I'm guessing you were not the only one offering ISAs. How do you create a product that is competitive right out of the gate? What questions were you asking yourself at the moment you decided to go this route?
Yeah. So we made a few choices that, you know, looking back, I'm grateful for. So one was, who do we want to be? Like, what parts of the value chain do we want to own versus not own, right? So where do you partner? Where do you build? And so, you know, we decided that, one, the fintech space is a relatively like regulated space, as you can imagine. So we didn't want to take any shortcuts when it came to compliance, and we didn't want to take any shortcuts when it came to making sure that we were licensed on the servicing front. And so the early entrants of the space tried to build servicing in-house. Servicing meaning where you collect repayments. Ultimately, I viewed it as working with a large scalable player as the servicer, and we manage what the comms looks like. We build on top of that. We do the reporting. That was a better together situation than us trying to reinvent the wheel on servicing. Where we were great is, what does the student experience look like on the front end? We need data science to underwrite the broadest swath of programs, and, you know, like the and students with great terms. We need to be great at capital markets to raise low-cost funding so we can drive affordability. We need to have a student experience that's really sticky on the front end, like a good branded experience that students feel happy, like same day real-time feedback on approvals and all of that. And so those were the pieces that we spent our efforts on that I thought ultimately matter quite a lot, right? And so, you know, I think it's just a matter of, again, where you choose to play. And the last piece is distribution. Like, how do you think about who you're working with and what's your ability to reach customers and reach students in this case? And, you know, we did a lot of interesting partnerships with schools, really thinking through, you know, how are we able to educate on the front end and get students in?
I want to cover that. I thought that is really interesting that you originally were B2C and then eventually evolved to B2B.
Yes.
So
Yes.
what caused you to make the switch, and would you do it any differently if you were going back? What was there did it end up becoming an advantage having started B2C?
Yes.
I don't know.
So it absolutely was an advantage to start B2C. I think that if you start, ultimately our business, it's not B2B at this point, it's B2B2C. So the channel, the go-to-market is B2B, but our ultimate end consumer is still the student. And so solving for the student experience and really understanding that first and foremost. I mean, I must have spoken with hundreds of our first students who applied, right? Myself now with the whole team, and so many data points on like, what are the types of questions they ask? What are they seeing with the platform experience? What are they looking for? And who are we not accepting? And are there ways for us to think about where our capital should be spent next, right? I think that really helped. But from a scalability, speed and market, and the types of programs we're going after, B2B really supported our ability to grow and to work with high quality schools, and also to expand from degree to also non-degree programs. And so that's really how we thought through it.
When you originally starting up signing up students, so first thought that comes to mind is, from the get-go, was that I don't know at the time when you got started, because obviously when you're talking about customer acquisition, it's based on where people are, where eyeballs are, and who the customer is. But in that scenario, first couple students that signed up, what channel was most effective for that?
Yeah, so the first few, the very, very first, this is on the B2C side, the way that we worked was one through, some affiliate partners, honestly, some social media marketing, and then some word of mouth. And also, I did really manual things in the early days with like a very small team, including some interns, right? That was like putting flyers up at schools.
I love that.
It's funny. I think one of our first students
bring it in old school. It still works.
It actually it is funny to think about it, but it really was an effective strategy at that time, right? And
that was one of my first experiences in business, putting flyers.
Yes. Like, and now we have like ads in subways, right? It's just, there are ways that still work, and you know this well, but people need to see your brand a few times to build that trust. Just like when you buy a product online, you probably have seen it 2 or 3 different times from different channels, right? Targeting's almost a little too bizarre at this point, but yeah.
So those through a word of mouth, through affiliate channels, through even going back old school flyers, and obviously social media as well during that time. How long has the company been around so far?
So we started funding students in late 2019, early 2020.
Okay, all right. We're not talking too late here. And so when was it that you started this way? I'm sure you're very excited, and you're like, oh my God, we got students that understand this pain and they're going through it. When did you realize that maybe the fee structure or what you currently had might not be feasible, or when did you come across an obstacle that you said, let's start thinking about another route, because this might not be working?
So, it's interesting because I think about this with, I'm sure you've watched Shark Tank before, right? it's funny because if we were to go on to Shark Tank, let's just say, it would be less beneficial for us than it would be for a consumer, because a financial product is not an impulse purchase, right? There's an education piece that's required that's very different than other types of products that you can offer in the market. And what we realized was B2C for student lending, now we launched our more traditional loan products, but we used to primarily have our most student-centric product, which was our income share agreement. That required education, right? What is this product? Why is it so good for me? What do the features mean? And someone's finding out about you just through an affiliate or social media marketing or, SEO. Like, it's just a little bit more challenged, right? Because when you think about that funnel, it's different. Whereas when it comes through a trusted party, like through the school, their financial aid or through their enrollment office, suddenly, one, they're supporting the education pieces. And we also did a better job at cost calculators, videos, all sorts of tools to play with. I mean, you also grow and evolve on what that looks like. But we realized that, in order to do this right, we needed to understand where we were shown to students, how we were shown, and what the level of education was at that point around our products. I do think now with our more traditional loan product, perhaps that changes a bit. The reason for the order of operation was our more traditional loan products, there was just a lot more legwork on the regulatory front to work with a chartered bank or a sponsored bank partner to get the equivalent of 50 state licenses.
Oh, interesting.
So there's just things from a timing perspective that we couldn't do the simplest product yet. And
was that one of the big obstacles facing too?
So I think that, it goes two ways. We started with income share agreements for two reasons. One, they were just intellectually interesting. I mean, why I came into the space was because I was like, wow, we can offer a non-cosigner product where we underwrite based on debt over future income, right? And we can structure the actual product design to protect students and their downside, which is awesome. What I learned over time is, there are ways for us to still be very student-centric and still underwrite without requiring a cosigner, but have a more traditional product design. But in order to offer the more traditional loan, there's just a number of things that you need to do from a licensure perspective on the front end that take real time and real resources. And the funny thing is, now the ISA space has also become more regulated. And so it naturally, almost weirdly worked from a timing perspective, where suddenly we were already proactively gearing up for launching our traditional products. And just as we did, our more innovative products also became regulated, and we're like, great, it applies for both, right?
Wow.
And so timing, like, that is the other lesson in life I've learned, is just the importance of timing in so many ways. I mean, timing for when we entered the market. We weren't the very first player in this space, but it's second mouse gets the cheese, right? Timing for how your order of operations is of when you're building what, right? Based on the market environment and appetite, and how applicable what you're building is for what you're doing now and your kind of future roadmap. It goes a long way.
So many moving pieces. It's wild. When did you iterate in terms of pricing, how you got paid? Was that something that kept iterating along the way, or after, I don't know, a year ago, it's been the same fee structure and it works? Or?
It's been a fairly similar fee structure, obviously a bit different when it was B2C versus B2B. But in the B2C market, one thing that we've held true on is we've never had students pay us. Like, if you look at federal Grad Plus loans or a lot of private loans, they'll have origination fees that they charge students, or all these kind of upfront fees. Kind of built into the cost of your product that you may or may not realize. We have never included fees on top of kind of the interest to students at all. So the only payers for us have always been investors and schools. And the difference just being in our B2C, it's mostly investors, and in our B2B, it's a mix of schools and investors. So, but ultimately the types of fees have stayed fairly consistent over time. And I think you get natural market feedback, and if it works, it works. And, you know, we price very fairly, but we also offer, you know, a lot more than just a pure play financing provider. So,
As I asked about the first time you signed up students, what about universities? What was a channel for you that worked with universities when you approached them and we started signing them up and building up those partnerships?
Yeah. So it's different on the degree and non-degree side. On the degree side, you know, ways to typically grow pretty naturally with them are you get on their lender list, which is their financial aid office is really supporting you as a potential school partner. We have done more intimately involved partnerships with universities, as we did with Stanford Law School, and that was a really cool initiative. But on the non-degree side, I mean, it's funny, we just hired our head of sales, but we grew this, you know, in 2021 about 6x in this past year, you know, we have about 5x the number of students. It's crazy. And that was all, you know, mostly inbound through conferences. You meet these schools and they talk to each other, and then we'll get notes being like, hey, XYZ, you know, founder of this school mentioned that they work with Stride. Could we
I
check?
love that. So again, word of mouth, once you get in one of those universities and you're doing a great job, clearly,
exactly,
then it spreads. And for you to get in front of the people you need to get in front of, I'm guessing you mentioned conferences, but was that a big play also?
Yes. So, yeah, we've been fortunate that even at a pretty early stage, you know, I think part of it is people talk about market share and mind share. We had a lot of mind share as far as really being invited to speak at a number of conferences where a lot of the schools would be based. And I think the beauty of that is, you know, when you build a lot of trust early on, and you also get a pulse, right, of what are their needs. Like there's nothing better, you know, I think that as the market evolves, also the types of things that folks need, what they're prioritizing, how they think about, you know, the types of solutions they need for their students, that just evolves, right? And we try to not be complacent on that front too. So
in terms of fundraising, so you raised equity and then you also raised debt. What's the difference in terms of your journey as a founder, raising from each side? What's something that you notice is, whoa, whatever you say here doesn't really apply here? What does that look like?
They're totally different. So we've raised, you know, about $20 million of venture capital on just for people and platform. And then we raised about 150 million just to fund our students. And that's credit capital. So first of all, venture investors and credit
investors. Just to make sure, do you say 100? Because it sounded like a million. I don't know who it was.
150 million.
No, and for the equity, it was
and 20 million.
Oh, 20 million. Got it. It just sounded like million, and I didn't hear the 20. So not 1 million, 20 million in equity, and 100
million for our venture. And 150 for our credit. Yeah. So the way I would think through it is they kind of work in reverse directions. The venture investors are so focused on how we think about our upside, our ability to grow, our LTV with our customers, the brand that we're building, the roadmap, etc. Right? What's the ultimate market that we can tap into? Whereas our credit investors are much more focused on, well, downside protection, right? How are we structuring these facilities? What's the asset class look like? You know, what does historical performance look like? And, you know, I think both are important. If anything, they kind of keep us in check. It's like, we want to grow and we want to do it in a way that's like thoughtful and it's easy to get
as quote safe as possible. Right. Yeah.
Exactly. And so it's funny, but I would say, you know, there are also very different types of investors on our, you know, credit side. We've worked with large banks, credit funds, impact investors, and we've basically, you know, structured these as special purpose vehicles. We have 3 special purpose vehicles that we raise this capital into and fund out of. On our venture side, though, it's really focused on like being thoughtful on what is our spend on. It's mostly people, right? And then it's people and platform, it's tech, it's and it's thinking about how are we efficiently allocating our own resources, which is around whatever we do. Is it helping with IP? Is it helping with revenue and market share and customers? And how do we continue to just have really good, OKRs and KPIs as a company to keep ourselves in check, right? And on the credit side, I mean, it's performance of our assets and growth of our assets, right? So, yeah.
So these last two questions are related to recruiting.
Yes.
One is, when you created Stride, did you raise right away for it, or did you already have certain traction and then you raised for it?
Yeah.
And it leads me to ask the second question, which is, when did you begin making your first hire outside of founders?
Yes.
And when did you think it was the right moment to do so?
Yeah. So good questions. So first, as far as how we thought about timing around the fundraise, early on, I think you really got it. Like, I at least just sussed out, is there really market appetite here? Everyone tells you whatever you say sounds great, but until people are really willing to actually sign up for your product, put money about this, like, it's all talk. Talk is cheap, right?
Yeah. Not until you see that money arrive in the bank. Someone paid for it. Yeah.
I mean, I think that, like, hearing lessons of, you don't have to make every mistake yourself and you can learn from others, that's valuable. But hearing, yes, this is good, and that alone is not enough. And so early on, it was just sussing out, hey, before I can even launch, I can't give away dollars without feeling good about our model, about the actual experience for students. Like, there's something, like, this isn't as simple as, let me put up a landing page and see if there's demand for the product. I mean, maybe, but like, once I actually deliver the product and push out dollars, there needs to be some rigor to that. So we did a number of things. One is, I started with just a lot of interns and folks supporting us, right? This is pre-funding. I wore a lot of different hats. And then after that, I had brought on my first full-time hire right as we're about to kick off our fundraise for our seed round. And that was also the same summer that we were gonna go live with the product. At this point, we'd built the first iterations of our pricing and underwriting models. We brought in some assets from another company with some future payments based on milestones. That's how we'd structured that, to kind of accelerate our time of having some rigor around our models themselves. Went to market, had a fairly simple platform, but all of the right kind of consents and disclosures, because you still need to do things in a buttoned up way in the space. Saw what the student appetite was, had a pretty limited amount of funding, started with like a low six-figure that we were going to split across students. So I didn't use any of that capital for actual operations. Like, no one, I wasn't taking salary, other folks weren't taking salary yet. There was, any of the expenses for travel or things that we're building or subscriptions we're signing up for, I just paid out of pocket. That's what you do early on. It is what it is, right? Like, you got to have something. And then, we use that family and friends funding to fund the students. And then once we had that proof point that, hey, there's real demand here, if I could fuel it with more dollars, I think this could really work. That's where, kicked off our fundraise. Funny enough, we actually just did a few coffee chats. And before our formal kickoff, we got preempted with a term sheet, and then we had a few more term sheets that following week.
Oh, that's amazing.
The venture investor we wanted to work with, we love.
It's that first term sheet that is so hard, because everyone else, they're like, we love it, this is interesting, but like, we don't really lead, or we, like, no one leads, or the ones that say they lead don't lead. Yes, I know.
Yes. The first one really changed the game, right? And once we had the first term sheet, then I began really like starting to build up what the full-time team look like, and investing in,
Who's the first one? Shout out to them, to all the founder community here.
Yes. So my first full-time hire, his name's Patrick.
Oh no, I mean VC.
first VC was GSV Ventures. They're amazing in the ed tech space.
Awesome.
And honestly, very grateful. So GSV Ventures and Slow Ventures were the two largest investors in our seed
That's
round.
awesome. Very cool.
And we had a really great mix of one who knew our space and one who really knew our, the broader tech.
And shout out to Josh. Who was it that you said was the
Patrick.
Patrick.
First full-time hire. And it's all about the folks who take early bets on you, right?
100%.
So,
100%. That's really cool. That is very, very helpful. I want to see if I one last question here. Did any advice to founders that are just getting started, seed, even every level I've come across, whether it's Series A, Series B, I have many founder friends, and it never gets easier, right? There's always an additional challenge. The Series A, the Series C guy says like Series B was much easier. The series, right? It's kind of so. But in your case, what any advice so far in your journey for any founder out there in what they're doing, what they're trying to do, anything?
Yeah. Well, one, I would say, I don't know if I would call this a job, but of all the jobs I've had, this truly, genuinely is my favorite, because I feel like the beauty of running a startup is there's just really sharp learning curves, right? And the hats that you wear change so often. So find the things that are energizing, find the people that, if you are the smartest person in the room, when you're running your startup, you're probably doing something wrong, right? It's like truly about finding folks that are just great. And initially it's like Swiss Army knives, right? And then it evolves to people who specialize, but are kick-ass at specializing and are willing to roll their sleeves up with you, right? And ultimately what I'd say is early on, ask a ton of questions. Like I said earlier, you don't have to make the mistakes yourself to be able to learn from them, right? And so talk to a lot of other founders, especially those who tried to enter spaces and it didn't work, because if anything, that really shows you what matters most for your spaces around distribution, unit economics, the ways you're actually building the platform, and the ways you're really managing, the customers. And then lastly, I think you started this with how important community is, Alejandro, and I think, it can start as a fairly lonely journey as a founder, but there are lots of ways to make it less lonely. And part of that is, the community of friends who are going through a similar journey, even if it's not the same business, those relationships matter a lot. And some of my closest friends are fellow founder friends, and, we can share each other's joys and also rant about things together. And that's really special to have.
We can be each other's therapists.
Exactly.
But it is very helpful. It's very true. And that mental health is real for many people out there. So founders and their tech startups. So I really appreciate that. I appreciate your time. Thank you again so much for just sharing your journey with us. Anything else, any other thing you'd like to share about Stride, and for anyone out there that is thinking of alternative financing for their tuition? Anything else we should know about, like, future plans?
Yeah. So look, I think, for us, again, we're continuing to build out the number of menu options. So the types of funding products available. The beauty is we play across degree and non-degree programs. But ultimately, I think the goal is to figure out what else do these same borrowers really need in their journeys, right? And how can we be helpful? And I'm always open to input on, what folks have seen, what they wish they had. Or separately, if someone's building something and just wants to talk through building in general, and I'm always happy to just be a sounding board as well. So yeah.
Awesome. Well, thank you so much for the time.
I love it. Thank you so much, Alejandro.